Hello, everyone. I'm delighted to be here. I was introduced as a professional athlete. I may want to correct that by saying straight away that I am actually, since 2016, I am assistant professor of finance and accounting at EDHEC Business School. And I can tell you it's probably less exciting than being a professional athlete. And this is actually the reason why I stand in front of you today, and I'm not planning to speak about accounting, because if you ask my students who have the joy and the experience to go through 2-hour session of advanced financial accounting topics, and when you see them coming out being, somehow extinguished, so it's probably wiser not to speak about accounting today. So the plan is for me to walk you through my previous life, and not to give you the boring detail of my life, but maybe let's speak about merger and acquisition. Depending on where you stand around the topic, being the buyer or being on the selling side, there could be a lot of emotions. We've heard about emotion today, especially those relating to the work environment. I'm going to tell you about potentially one side of the story where we are not going to speak too much about the social impact on merger and acquisition, because this is a form of consolidation. There is the idea that there is redundancies, and so on and so forth. So what I would like to speak about today is I'm going to try to make a parallel between the role of a merger arbitrage analyst and the one of a private investigator. First, I would like to give you a little bit of background about what merger arbitrage is, in case you're not too familiar with the topic. Merger arbitrage, also called risk arbitrage, is one of the many investment strategies that seek to exploit some kind of market inefficiencies between or before or after a transaction has been announced. Sophisticated investors, called arbitrageurs, seek to estimate and take benefit of the probability that such a transaction will complete and the time required until completion. However, if you consider any basic finance book, the definition of arbitrage is quite specific. Arbitrage is the idea that you can implement a strategy that will yield to some kind of guaranteed profit. So for instance, you buy an asset in one market and you simply resell it in another market, and you profit because in that other market there are some kind of market frictions due to import duties or tariffs. Okay? Here, merger arbitrage is far from being riskless. In the worst case scenarios, arbitrageurs, they can be wiped out and actually incur massive losses because they typically use leverage, i.e. they borrow, in order to try to magnify their returns. In its most basic approach, merger arbitrage requires that an investor be long the shares of the target company, i.e. buy those shares. And that would be required in a typical all-cash transaction, i.e. another entity buy the other one, the target company, using only cash. A variation of this approach where the buyer uses both cash and what we call paper, i.e. its own shares, would require the arbitrager to also short the shares of the buying company. Here, there is a graph that represents a transaction that I followed a few years ago. This is a U.S. company, a U.S. semiconductor company called Analog Device, which bought another peer called Linear Technology by offering a mix of cash and stock. You can notice on this picture that once new information has been made public to the market, there's been an immediate re-rating. The share price of the target company jumped. However, that share price never met the offer price, which is here shown as this horizontal red line. So between the announcement until the completion, i.e. the time the transaction is closed, the share price of the target company trades at a discount to that offer. There are two main reasons for such a phenomenon. The first reason is that the existing shareholders of the target company are happy with the deal transaction. They are happy and they take their money, they take their gains, and therefore they avoid what we call deal completion risk. The second reason is that this is an announcement about a project, and there are some uncertainties about such a plan. So therefore, this discount that we call in the industry the spread, the difference between the offer and the share price of the target company, such a spread fundamentally represents the risk that the transaction may be altered, that the transaction may be delayed, and in the worst case scenario, that the transaction does not complete at all. So this spread is actually the opportunity offered to those that venture into merger arbitrage. Now, merger arbitrage is or has gained traction since the 1980s. There's been a lot published about it in form of academic research, in newspapers. You even have dedicated talk shows about it. And especially researchers have came to some kind of consensus, and they've agreed on the fact that merger arbitrage strategies do tend to produce excess returns that are uncorrelated to equity and debt markets. So this is extremely interesting because that implies potentially that those that venture in merger arbitrage can perform well even though markets are going into severe downturns, such as right now with the conditions that you know. So many researchers, Dukes, Caroline, Jindra, did find empirical evidence that return provided by those strategies can yield 2-digit or sometimes 3-digit. Mitchell and Pulvino in 2001, they find evidence that such transactions are actually costly. The transaction costs are extremely high. More recently, Boursassa and Ferreira have actually done a thorough analysis and they have documented the reason why such strategies are impactful and what are the good reasons to pursue those. There is a but. Merger arbitrage is not good for any type of investors. There are many reasons for this. For practical reasons, merger arbitrage requires size, requires capital, and most of all, the ability to short. In addition, arbitrageurs need to have access to talent in forms of traders, but also in terms of getting access to analysts and also having access to information. Merger arbitrage is costly and difficult to deploy. The research has shown, for instance, through the work of Mitchell and Pulvino, for instance, they've studied a sample of U.S. cash and stock acquisition over the period going from mid-1960s to mid-1980s. And they did find evidence that merger arbitrage, the cost associated with that can consume roughly 6% of the annualized return earned through merger arbitrage. So extremely costly to implement. More recent data released by the hedge fund research organization, they have been able to track performance of hedge funds, those actually investors that are better equipped to deploy such strategies compared to individual investors. So the Hedge Fund Research Institute has been able to track performance since 1990, and they've found those numbers prove the following. First, the belief that merger arbitrage can yield better performance than the market as a whole is not correct. And second, the idea that merger arbitrage performance is somehow uncorrelated to market performance is somehow true. As we can see on that table, we notice two things. Over the various study periods, by holding a proxy of the market, i.e. the S&P 500 in the US context, did actually historically yield higher returns than engaging in merger arbitrage for those various periods. Except since the beginning of this year, 2022, we do notice that merger arbitrage strategies are providing returns that are, even though small, but they are positive compared to those provided by the market portfolio. There is something that I have to mention here. Those numbers are only proxies because the merger arbitrage index here compile data coming from hedge funds. And those returns are our net of fees. If you are a bit familiar with the industry, the typical remuneration is 20%. So we cannot make a significant conclusion from this type of comparison. Now, having said that about what is merger arbitrage, I still believe that the concept is still exciting for several reasons. If you look at the investment required in finding the information, understanding industries, understanding companies, understanding customers' behaviors, you would probably realize that when portfolio managers, those portfolio managers that work at hedge funds, when they come to analysts, they've got several questions. They want to know if the transaction that has been announced between company A and company B, is this transaction going to materialize? Is this transaction going to complete? There is the role of merger arbitrage analyst. These individuals are responsible to carry in-depth investigation of those transactions. And similar situation, M&A, merger arbitrage are not the only example of event-driven transactions. And those analysts need to be curious. They need to find details about, for instance, what's happening in the food retailing industry. What's the competitive landscape in the pharma industry, especially for cancer, for instance. So when you are a merger arbitrage analyst, it is important to develop an expertise that is, I would like to say maybe a word that I've heard today, use this generalistic view of the world, to borrow the word of somebody that has used that today. Merger arbitrage analysts need to be curious. They need to find information potentially about the ingredients that make drugs that are used for treating cancer. They may need to also be curious about fishing techniques. They could be also curious about the production of food products. This is useful because they can advise portfolio managers also not only about specific deals, but also how those deals relate to each other. So for instance, merger analysts can help promote what we call industry diversification in such a way portfolio managers can avoid having invested in deals that could potentially close or fail at the same time. To develop those qualities, merger arbitrage analysts needs also to be organized. They perform under time pressure. When a deal is announced, portfolio managers need to know quickly whether the situation is a situation that needs to be added to their portfolio. So again, analysts need to invest time. If they are not familiar with the industry, they need to invest time in finding the answers. They need also to make a recommendation rather quickly. To develop such an expertise, analysts need to be resilient. Despite having produced in-depth M&A reviews, that does not guarantee that a transaction will complete. For example, a transaction can close because the managers on both companies did not get along. Or sometimes a prominent shareholder in the target company can make a case against the deal and can successfully lobby against its completion. So analysts need to learn from past failures and be ready for next opportunities. To develop such expertise, analysts need to pay attention to details. The M&A industry is known for the role of lawyers, and that translates often in the production of sizable legal documents. In the US context, one of the most common documents is called the DMA, a Definitive Merger Agreement, which is a sizable document which typically provide details about the deal's conditions, the consideration offered, the maximum time allowed until completion, and also the so-called breakup fee, and sometimes the reverse breakup fee. So analysts need to study such documents, and again, the fine print, the semantics is extremely important in doing that exercise, because analysts need to be aware, they are the eyes for the portfolio managers. They need to understand what are the potential bad scenarios and their potential financial consequences. Lastly, analysts need to be pragmatic and run the fact checked. Technological breakthroughs, the advent of social media, for instance, have pushed so much the amount of information which is reaching us. Analysts need to run the fact check, and they need, for instance, to understand whether information that impacts share prices has been information that has been formally released by recognized authorities and not the information that has been tweeted and retweeted multiple times by so-called parties that are knowledgeable about the deals, okay? Having said that, how can we learn from this? Well, if we take those analyst qualities that I hope are qualities, and if we take that outside of the merger arbitrage industries, we should all ourselves think about what those bring to us. We should be curious and humble enough to recognize that the world that surrounds us is beautiful, and we probably haven't explored yet all of that beauty. Going to the mountains, discovering wonderful tea farms around the planet are probably great example of what we need to do. We should be organized because time does fly, and we need potentially to prioritize. Again, I've heard that sometimes in periods of uncertainty, when everything seems to crumble around us, we need to slow down and then maybe do a check on what are the priorities, especially, again, if you are underneath the Grand Canyon and one of your friends is having some kind of respiratory difficulties, you know that you got to be thinking twice. We should be also resilient because we do face successes, but we also face failures. And those should be the building blocks that help us elevate our potential. We should be pragmatic and run the fact check. Again, we are every day bombarded by information. We are bombarded by data, and the fancy term today is big data. But in all of that, we also find fake news. So we need to come down to the bottom and make sure that to ask ourselves, does that make sense? We need to be vigilant, and this is going to be my last word. Thank you for your attention.